Today I'm going to go through my Thackray's February 2025 newsletter. I'm going to highlight some of the summary points in the newsletter. Some people prefer to watch a video rather than read, or listen rather than read. So I'm going to go through the summary points and probably add a few points along the way. At the beginning of my market update, I put the GDP for the US, and I'm going back to 1978 to 1988 here to show the effect that Reagan had when he got into office. Now, the reason I'm doing that is that a lot of people are comparing Trump versus Reagan, some of the same objectives in creating efficiencies and cutting costs. Now, I'm not going to be political in here. I'm just talking about specific actions. And Clinton also, as well, really went through and laid off a whole bunch of government employees, etc. But really, the person known for the supply side and tax cuts is Reagan. And Trump is trying to follow some of these things as well. So let's take a look at the GDP back in 1981. Reagan was actually elected in 1980, but he started his term in 1981 in January. Now, he actually implemented his tax cuts halfway through the year in August of 1981. If you can take a look here, really we had a few negative GDP quarters after that. In fact, you can see here there's a recession, an official recession after the tax cuts. It wasn't until much later on that we saw that big payoff on the GDP increasing by reducing regulations, cutting taxes, etc. Everything has a lag. So what Trump is doing now, if you think that that's going to help the economy later on, yes, that could be the case, but it's not going to have a large positive effect in the short term. Trump may actually be trying to get all the bad stuff out of the way at the beginning of his term, knowing that midterms are in 2 years' time, but everything has a lag. Here's the S&P 500 in that same time frame. Here you can see that Reagan started in 1981, and look at the S&P 500. It actually went down. Really? Into 1982. So well after the tax cuts took place, and then we saw it rally up here. So once again, there was not only a lag in the economy, on the GDP side, but the stock market. It didn't start taking off for a couple years after he took office. This graph shows the expectations of someone getting a new job within the next 3 months. And what you can see here is, the big note is, we saw this spike, and here's 100,000 employees earning 100,000. We saw that really increase coming into the election, and it's actually started to come back down again from here. So there's a lot of expectations built up with Trump coming into office, and we've seen that pull back a bit. In my market update, I also talk about the tariffs. It's been a fluid situation. Everything keeps changing. But Trump has stated two objectives with the tariffs. And that is that he wants to fund America through the tariffs and take away income tax because of the tariffs. That's not going to work. It's a mathematical impossibility. There will be tariffs on different parts of the other countries, etc., and different products. And this is changing all the time. But you can't have your cake and eat it too, okay? So you can't tariff everybody coming into all products come into the country and have no income tax. It just doesn't work. So we're going to see a lot of changes, and he keeps changing the language that's going on here, and it's a very fluid situation. I think the narrative that Trump is just putting out the tariffs as bargaining chips, without getting into all the details, I think that could be a little bit false. I mean, Trump is going to have to end up with some tariffs on some countries, on some products. And what we saw at the beginning of February, we saw the tariffs come on to Canada and then be removed the same day with a pause for 30 days. And then the stock market rallied strongly, the Canadian dollar rallied strongly, etc. And the narrative from this is that Trump's just using this as a tool, and it's all going to back away and end up with, you know, it's just, we're going to be fine. There's going to be no tariffs. That's really what the market is sort of pricing in. I'm not a big fan of that. I do think there are going to be some tariffs in the end. And the best way to think about this is, if this is the time to tariffs, and we don't know when that is, because it's a 30-day pause, there could be another 30-day pause or another one after that. As we get closer to that day, then the narrative is going to change towards that, and the impact of possible tariffs will actually have an impact. So we're going to see this decline or decay over time, where tariffs are actually going to become more and more important as we get closer to the day they're about to be implemented or even extended. I talk about the seasonal trends for February in the newsletter as well. And just so you know, February here, from 1950 to 2024, is one of the weaker months of the year. Yes, we are in that strong seasonal period for the stock market from late October to early May. But February, if you take a look here, the cross is a median, and you can see here that there's no bar because it's really zero here for February on average in that time period. So we're halfway through February at this point. We could see some further erosion, particularly the second part of February tends to be a little bit weaker. In my seasonal opportunities section of the newsletter, I start with gold, and gold has been on fire recently. It was outperformed the S&P 500 in 2024 and is doing well in 2025. If we take a look here, we can see here we had a double bottom here in 2024, and then we saw that breakout take place in 2025. Here we are getting really close to $3,000. The big move in gold really has been because of central bank buying, and I've discussed this numerous times before in my newsletters and on TV, etc. But what we're seeing here is we're seeing outperformance for gold relative to the S&P 500. Will it continue? Well, I want to show you this graph here, and I talked about this when I was on BNN, Bloomberg on the street on February the 4th. What we're seeing here is we're seeing a shift in gold from the LMBA to the COMEX. Okay, so this graph shows the inventory in the COMEX, and what we're seeing is, whoops, a huge rise in COMEX. We're seeing gold bullion being drained out of the LMBA in London and brought over to the United States and being stored in the COMEX. Now, the official narrative for this is that companies and bullion banks are trying to get ahead of any possible tariffs. And so therefore they're trying to bring the gold into Americas to make sure that it's not being tariffed at a later date. There's a lot of other theories being passed around at this point, but it's bringing a lot of uncertainty in the gold market, which is helping by itself to move the gold price higher. Now, I do want to say that the seasonal period for strength for gold really finishes up in late January. So we're in overtime, but it can go into March under favorable circumstances. And that's exactly what's taking place here. But if we take a look at it from a technical basis, here, yes, we're all-time highs. But if we look at the price indication on the RSI, here we are above 70 and turning lower, and also on the full stochastic oscillator, poised to turn lower as well. So it could be possible that we could start to see the price, even though it has long-term fundamentals here of strength, we could see it actually pull back here a little bit or soften up. I also discussed silver as well, because silver tends to do well from late December, which is exactly when it started a strong run relative to the S&P 500. Right in that time period. It doesn't always work that way, but we saw silver do extremely well. And technically it's actually looking fairly good. Here's a pattern of rising bottoms all the way here. And here's our resistance line right here. And here we are up against this right now. And so this is an ascending wedge in technical terms. This is a favorable technical pattern. I do want to point out here that gold has been outperforming the S&P 500 in 2024 and 2025. But look at silver. Silver really, if you take a look, for just about a year now, has been flat to the market. So we haven't seen the same pickup with gold, primarily because central banks are buying gold, not silver at this time. But at some point, what we can see is that readjusts where we start to see more interest in silver. And we possibly could be at that point right now. I want to show you this chart. This is GameStop in 2020 and 2021. And if you remember, this stock was really trading around pennies, had a huge short against the float. It was around 140% at some time. And then investors basically, or speculators, went in and said, well, let's force those short positions to cover by buying large amounts of the stock and driving the price up, so the shorts will then have huge losses and have to buy no matter what the fundamentals of the company were, because they really were not very strong. And then they also start to buy call options, which further put pressure on the price going upwards. And we saw that squeeze take place, that huge short squeeze, and the concept of meme stocks was born. But did you know the same type of event was tried with silver in 2021? If we take a look here, we saw investors go in and say, well, there's a large short position against silver bullion. Let's try and squeeze this up high. And we did see the silver actually go up. It didn't work, and we saw silver actually come back down again. You could see further talk of another attempt with this silver squeeze again, possibly. So it's just something to watch out for. I want to show you this chart. This is the gold to silver ratio. And a lot of investors follow this. And it just says, what's the price of gold relative to silver? How many times more valuable or higher price is gold to silver? And if we take a look right now, we're around 88 times, which historically is at quite a high level. Now, we have gone higher than that here. You can see a spike in COVID, and we were higher back here in the early 80s as well. That goes back to the Hunt brothers. But if you take a look here, around the 80 level here, we can see some peaks here. And very often what investors will do at this point is start to roll over and switch some of their allocation from gold to silver. So we could see silver actually still continue on here for a little bit longer. I also discussed the energy sector here. And if you take a look here, energy is the seasonal period of strength is from February 25th to May 9th. It's really been just holding in a consolidation zone. There's a lot of pluses for energy and some minuses as well. And it's really being worked out here. And it could be very volatile, but we are starting the strong seasonal period coming up shortly. If we take a look at the energy sector using XLE here, well, we're right here in that consolidation zone. And look at the energy sector in the US relative to the S&P 500 over the last few years. Has been negative. But we are coming into that strong seasonal period, and there are some pluses, like China is starting to show some economic strength here at this point, which could help the sector move higher. There's a war premium perhaps built into the price of oil as well, that if we do start to see peace, there's more talk of peace right now, that we could actually see that pull back a bit, but a lot of volatility, and we are in that middle section, so we'll have to see which way it goes as we start the strong seasonal period for the energy sector shortly. I want to talk about uranium. I couldn't help but put this post in here, this meme here. And it's Rodney Dangerfield. For those of you who don't remember, he's a comedian from the past, many decades ago. And his big shtick was, I don't get no respect. And, he would go on about this. And so really uranium sector is that sector right now. And a lot of investors in uranium are very frustrated because we see a lot of the metals and mining sectors is going up and performing well. We've seen gold do well, etc. And yet, we've seen the uranium sector stumble despite its really positive long-term forecasts that are really hard to overcome as far as an argument goes. And it really comes down to, I think, that investors really are saying, well, you know what, I love uranium and I can really see it being a good place to be later on, but I don't have to go there now. And we think there are other places to be. My personal belief on this is that when we get over the shiny ball syndrome with the technology sector and we start to move more into commodities, and we have started to see some of that rotation take place, we could actually start to see the uranium sector actually pick up and do quite well on a continual basis rather than just moving in spurts. Right now it's just moving in spurts where it moves up and then consolidates a bit from there. And if we take a look on a technical basis, well, here's the uranium sector using EURA here. On an absolute basis, look, it's from 2024, all 2024. The S&P 500 was up around 25%. And uranium, well, is up a little bit by URA, but really it just consolidated. And you can see its underperformance. And this is despite even recently the CRB index moving up to show that overall, in general, commodities are moving higher. This sector can really do well in the future. It just needs a catalyst, and also for investors to actually get interested in the sector in a big way. I want to talk about small caps. Small caps really are just not performing as well as you'd expect, particularly in their strong seasonal period at this time, which lasts from mid-December to early March. And I do want to make a note saying that the small caps tend to start to perform poorly in early March, and they have quite a strong track record of doing that. If we go back and take a look, here's IWM, and this is IWM relative to the S&P 500. You can see here that even last year in 2024, we did see the sector go down. And look at 2023, we actually saw small caps actually perform quite well in a strong seasonal period, but right as it ended, the sector went down. So at this point, we're going to see the strong seasonal period finish in a few weeks' time for the small cap sector, and performance right now is mediocre at this time. So watch out, perhaps in early March. I want to show this chart for small caps as well. What we saw here, once again, this is a little bit of what we saw earlier on. There's large expectations when Trump was elected. We saw this spike higher. This is showing small business sales actual versus expected. And so this line here is expected. As Trump was elected, we saw this huge expected Trump premium or Trump bump or whatever it is. But look at the actual. The actual is quite low here. So we could see that actually that euphoria pull back here a little bit. And that would not be good for the small cap sector either. I want to talk about the technology sector, which tends to perform well from December into late January here. But what we've seen really is the technology sector had this rising wedge and then it's broken out sideways here. And relative to the market, look at using XLK, look at the consolidation here. Really from 2023, December of 2023, all the way to now, we've been in a consolidation range. And we're so used to seeing the technology stocks go up, and that's relative to the market, and that just hasn't happened. We're starting to see some rotation take place out of some of the growth sectors or growth stocks and into other parts of the market, such as some of the commodity sectors. Interesting shift that's taking place right now in the market. I want to show you the industrial sector here. It usually does well this time of the year, and we did see it actually pick up here a little bit relative to the S&P 500. Right at the beginning of January, but it is starting to pull back here. And look at this, we're having declining tops here, which is not a good sign for the industrial sector. At this point, it may do okay over the next couple months, but it's not gonna, I wouldn't expect it to perform extremely well. The material sector usually operates a little bit with the industrial sector, which actually performed better. And that's because of the metals and mining component has also helped it. But look here at the beginning of the year, it's actually popped up here. But look what's happened here. What we're seeing here is we're seeing a consolidation box really form. And also relative to the S&P 500, we're seeing it move sideways here at this point. The material sector usually operates very similarly to the industrial sector. It's actually been better than the industrial sector because of the metals and mining component has been an influence here. If we take a look at the material sector here, we can see here that it popped up here in the early 2025, and now it's been consolidating in a box here, going back and forth, and it's been flat relative to the S&P 500. So at this point, it's best to typically wait and see which way it's going to break up or down here at this level here. We're still in a strong seasonal period for the material sector, so we could still see it move higher. Here's the consumer discretionary sector, and look at this run that it had in the last half of 2024 and outperformed the market, but it's actually broken that upwards trend and looks to be falling here a little bit. So we're seeing a breakdown in that sector now. The two largest components to that sector are Tesla and Amazon, so their performance can really influence the sector. We are starting to see some strain overall in the consumer discretionary. Here's the retail sector using XRT. And we can see here that had this real consolidation taking place. It had a breakout, which is positive, that took place back in, well, really in November, December. It's come back and forth here a little bit. It's actually got some lower highs, which is not good. We saw a weak retail report at the end of last week as well. We have seen the sector underperform here relative to the S&P 500. Usually this is the strongest time for the retail sector from late January into early April. But right now, that's starting to look questionable. If we take a look at Canadian banks, here we can see that using ZEB, we can see that this strong run took place on solid earnings last summer. And really what we saw here was we've seen some consolidation taking place. And relative to the TSX Composite here, strong run, outperformed, rallied a little bit, outperformed again, and we've come back to that leg right there. So we've really pulled back that outperformance level at this point. The Canadian banks really are tied to the economy much more than the U.S. The U.S. Money center banks are very different than Canadian banks. We do have some exposure to that as well, but Canadian banks are much more dependent on the economy. But they do have a fairly high dividend. So if we start to see the market stumble and the economy is okay, that can actually benefit the banks here. The big question always is if we start to see a major slowdown in the economy, we could see that actually come back into the banks. That hasn't happened at this point here. We do have bank earnings coming out next week. We've lost some of that premium that we developed in the banks over since the last part of 2024. So we could actually see the banks do okay if they come out with some good earnings here as we have pulled back. This chart is of the Canadian GDP, and I just put this chart up here because if we take a look here, right where we are right now, we've seen this really quite anemic growth after this artificial stimulus during COVID. We've seen the Canadian economy really move along very slowly here at this point. And as a result, if that continues, that's not good for the banks. I want to show you this graph from 2011 to 2024, and this is using ZEB, once again for Canadian banks. I wanted to point out that March can be weak. Okay, it's one of the weaker months of the year on a median and average basis. Something to watch out for. in this time period, it's only been positive 43% of the time. So earnings coming out, and March tends to be a little bit weaker for the Canadian banks, despite they're still being in the strongest seasonal period into April. But watch out for those earnings, because if they're negative, we could actually see a little bit of a downdraft for Canadian banks. U.S. financials have been very different. They've actually done quite well, okay, but they've been outperforming. If we take a look relative to the S&P 500, look at this here. We've seen this outperformance coming up even in 2025, but it looks like we could be forming a double top there. Something to watch out for. We're still in that strong seasonal period until mid-April, and we're still seeing some outperformance. At the beginning of the year, this was on nobody's bingo card, emerging markets. Everybody's talking about the Magnificent Seven, etc. But emerging markets have actually done quite well here. We can see here relative to the S&P 500, we're starting to see this pickup starting to take place. China's been improving in strength, partly because of their economy starting to show some stability. Also, there's been a lot of excitement around the DeepSeek as well, and we're seeing some money pour into there. And so we're starting to see this take place. Right now, we're at the top end of the trading range for emerging markets. Now, China is just one component of that as well, but we are starting to see some strength, and the boost in the commodity sector at this time has also helped the emerging market sector as well. If we see weakening of the US dollar, this is where the money could flow into the emerging markets. I want to show you the chart on the Canadian dollar versus the US dollar. And what we saw was, for a large portion of the second half of 2024, we saw the Canadian dollar decline in value relative to the US dollar. We saw some consolidation take place. And what we saw here was we saw this breakout of this box. It was really from 69 cents to 70 cents. But that's a false breakout, because there's a lot to do with the tariffs being paused for 30 days. And then we saw the breakout to the top side of this box as well. So breakout to the below, breakout above. It's going to be interesting to see if we actually continue with this trend here at this point, because the tariffs could come back into play a little bit later on. A part of this decline in the Canadian dollar versus US dollar, there's yes, our central bank rate is lower. It's moving down faster, and we look at the 2-year yields. That spread keeps growing, so that was really benefiting the U.S. dollar, but versus Canadian dollar. But look what's happening here. This is U.S. dollar relative to the world. We've seen it rise rapidly, and really in the last quarter of 2024. But we're starting to see this actually pull back down. If we see the U.S. dollar pull down relative to world currencies, the Canadian dollar could do quite well. Now, on a seasonal basis, the Canadian dollar tends to have its best time of the year, really from mid-March until the end of April. So that's just a few weeks away before that starts. So we could be actually seeing the start of that time period. Now, there's a lot of variable factors here as far as tariffs go, etc., and wars, etc. But on a seasonal basis, we're getting close to that strong seasonal period for the Canadian dollar. I want to show you this chart here. This is the Canadian dollar versus the US dollar, but it's from 2015 to 2018. This is when Trump was first elected. He was elected in 2016, and he took power in 2017. So if you take a look here, here's 2017. Look at the US dollar. This is US dollar relative to the world currencies. What we saw was a strong rally in the US dollar relative to world currencies, just like what we saw in the last quarter of 2024. And then once 2025 started, down the US dollar went relative to world currencies. Now, there's a number of reasons that took place, and the reasons could be different this time around, but a lot of investors are saying maybe the same phenomenon is taking place at this point here. Let's take a look and see what happened with the Canadian dollar. The Canadian dollar, despite the US dollar going down relative to world currencies for a few months, the Canadian dollar actually went lower as well. It really wasn't until around May that we started to see that jump higher. So the big question is are the US policies that are taking place right now, are they going to put downward pressure on the US dollar? And is this just going to be a reversal of like what we saw back in 2016 and into 2017 as well, where it got pumped up and it shouldn't have, and then pulled back down? And I finish off my newsletter with 2 rants. One is on the government overpaying employees, particularly in California. It seems to be an endemic situation. I've written about California before. I love California as far as the state goes, but it's very poorly run. It's got some huge issues here. And in this case, I'm talking about the water chief. Now, I'm not going to talk about the fire, the very, very unfortunate fire that took place in California. I'm just talking about the water chief's salary here. And so if we take a look, the salary for this water chief is $750,000 US. To me, that's kind of crazy, paying somebody that for that position that much money. And if you take a look at it, you have to understand too that in LA, their pensions are absolutely astronomical. I've dealt with this in the previous newsletters where we had lifeguards making in their pension over $300,000 a year for the rest of their lives. Now you go, how's that possible? Well, for some reason, the LA County decided that they would give their employees 90% of their salary in their pension. 90%, which is absolutely crazy. Typically, the best you can get in pensions is 60%. And they said, well, we're going to give you 90%. And on top of that, they said, well, if you work overtime, we're going to include those overtime hours and into your pension calculation, which is just unheard of. It's usually based upon the base salary. So you would find that the lifeguard in the last 5 years would take all the overtime. Everybody would give it to them because it was going to be their rate very shortly. And then they would make massive amounts of money over the last 5 years. And then they would have this pension of over $300,000 per year, which is just insane. So I was pointing out here that there seems to be an endemic situation where the government is overpaying people, and it's really going to put a burden on the state in the future and drive costs higher as well. Now, their pensions were in trouble going into COVID, but what we found was that the Biden administration really came in and bumped them up and to help them out a little bit. But they still could run into trouble again later, particularly if you're paying people huge amounts of money in your pension that's just unsustainable. And so I was just using this particular water chief as the latest example. My second rant deals with Canadian companies moving to the US. And it's starting to be a growing trend, and I think it could really get out of hand unless Canada actually does something here. And we have seen in the past large companies like in Canada move to the US. Canada tends not to be a favorable country for resource companies. The biggest company that comes to mind would be in Canada, moving to the US. Now Barrick is considering moving to the US as well. A little bit of a problem, and if we start putting on extra taxes on corporations for whatever reason, without going into all the details, the companies are going to say, why would I locate in Canada if there's going to be taxes that are put on us for whatever reasons? And they're going to start to think twice about that. And if particularly if we come along and say, well, now we're going to start taxing other products coming into Canada as well, steel products, etc. That makes it an isolated situation. So if I'm an international resource company, do I really want to locate in somewhere like Canada? So we're going to start to see some companies moving out of Canada into the States. I think this is probably going to be a growing trend anyhow with the tariffs. Uncertainty on a go-forward basis is also going to provide some companies to say, well, why am I in Canada if most of my market's in the US? In fact, just recently we did see two Canadian food producers plan to leave Canada, and their real reason was it's most of our market down there. If we're going to have tariffs being put between the two countries, do we really want to do this? Why not just go down to the States where we make most of our money? I hope you've enjoyed my summary of my February Thackray's 2025 newsletter. Thank you.